Hey guys, in this video I will explain what are account receivables, why they are needed, and what are the other implications associated with them. Receivables are our credit customers. They buy from us now and they will pay later. The receivables are an important element of working capital management, and most of the businesses, medium to large size businesses, they actually have a separate department which looks after their receivables, and that is called credit control department. Receivables are selling on credit is a necessary evil in the business world. And the reason is that it has advantages and disadvantages associated with it. One of the reasons we allow credit to our customers is because we want to sell more. If we sell more, we will make more profit. However, the problem with selling on credit is that when we sell on credit, we get drained out of the cash. We have sold our inventory, and if we have to pay our suppliers before our customer would pay us, then we have to come up with that cash from somewhere, maybe from a bank overdraft or maybe a short-term loan. However, if the customer pays you as agreed, then it shouldn't be a problem. In the long term, businesses would work out a cycle which would work for them. However, the problems associated with receivables are that sometimes customers do not pay on time. Then some customers go bankrupt and they are not able to pay at all. Now, to solve this problem, you have to hire staff. So when you hire a credit controller and people in the credit control department, you have to pay them salaries, which cost money. So that is another issue with it. And if you would not sell on credit, you would rather sell on cash, you can keep that cash in our business current account where you can earn some interest. So losing cash when you are selling on credit is also the reality of credit sales or having account receivables. As I said, the credit control department is responsible for managing account receivables of the business. They run regular checks on potential customers. Who would get credit and who would not get credit is the responsibility of the credit control department. Then after we give customers credit, we keep a check on them, and this is also the responsibility of the credit control department. Credit control department would also set credit limits for each customer, and they would apply 5C criteria to check if the customer should get the credit. They would also create regular reports on who is paying on time and who is not paying on time, and hence chasing up the overdue receivables. They would also advise accountants on what are the chances that we may not get this much money back. As this happens regularly for the businesses selling on credit, credit controllers usually have an idea that this much percentage, for example 3% or 5%, would not pay us. These are called general allowance on doubtful debts. However, sometimes they actually know a certain business or a couple of certain businesses who they know are in financial difficulty and they would go bankrupt. These are the people who are called specific provisions for doubtful debts. And then there are customers who we know that they would not pay us at all because they have gone bankrupt or they have disappeared. So we would call them bad debts. The slide on the screen gives you a typical analysis of receivables, and in this management report we can see that 65.4% sales which are collected within the 30 days. Then 27.3% of the sales are collected between 1 month and 2 months, and then there are 6.4% of the debts which are collected between 60 and 90 days. And there's a very small amount which is collected over 3 months. Then we will compare it with the previous months and then previous year averages to see what is the performance of credit control department. Most of the businesses, they have limits on this data. For example, they would say that, okay, we would allow up to 70% people to pay within 30 days, and we would allow only like 5% of the people to pay us after 3 months. So in this case, for example, the limits could be to collect 70% of the debts within 30 days. So credit control department has failed in this specific month. It's only 65.4%. However, if they have a target of, let's say, they would allow 5% of their customers to go over 90 days, then in that case, credit control department is performing better in that area. So there will be different criteria set, standard set, and credit control department would be responsible to meet these targets.